Thank you, Jeremy. All right, well, I hope everybody can hear me. It says I'm screen sharing, so that's a good thing. Well, anyway, good morning and thanks for joining us. Herb Vogel, our COO and president, and Wade Purcell, our CFO, are here with me today, and we'll be taking your questions a little later. And I'm going to make sure we have plenty of time for that. There's no point in belaboring slides that I'm sure you've already seen, most of which were presented at our quarter. And I'm sure you also read the transcript from that. So today, I'm really only going to highlight some important things that I think real investors in companies like ours should care about. You know, as I was preparing for this discussion today, it struck me how many times in the 40 years I've been in this business, I've been through a price cycle. And it always happens, but for whatever reason, no matter what reason it is for the price cycling, there's always a crowd shouting that this time it's really different, that this time it means the end of the road for companies like ours, and that everybody should run for the exits. And it happens every time. And I think you have to look at the cycle, and think about what you should be doing at each point in that cycle. And that's certainly what we're doing, managing through for the long term. So I'm going to start on slide 3 and just talk about the fact that our priorities, regardless of where we are in the cycle, don't change. Our priorities are always the same, and we're focused on growing cash flow per debt adjusted share. And we intend to do that by growing cash flow through the cycle, generating free cash flow, and reducing debt. Those of you who know us know that over the last 5 years, we've made a great transformation in improving our investment portfolio. And after recovering from the impacts of the necessary asset sales to fund that transformation, we began generating free cash flow last year in the third quarter, right on schedule according to our forecast. In the last 12 months, we've generated almost $125 million in free cash flow, a number which is about a 35% free cash flow yield compared to our current market cap. That $125 million includes $28 million in this year's second quarter, which of course was a messy quarter due to production shut-ins and deferrals and abnormal dislocations in price realizations due to changes in the roll. But it's a number that no analyst predicted, and is really a credit to our performance. Now, obviously, as we go forward into 2021, we're going to take a step back in cash flow generation just due to the fact that the hedge prices you can hedge in 21 are lower than they were in what we hedged in 20. But as we come off the bottom of this price cycle, we'll be drilling and completing wells at a substantially lower and deflated cost, and we'll be making good returns. Throughout the cycle, we have several key and very distinctive competitive advantages that I want to speak to. So let's turn to slide 10. Here we're showing some work by a third party which indicates that our Midland Basin wells had the lowest break-even prices in the basin prior to the downturn in prices. Now that's a function of the exceptional geologic qualities on our acreage in the Midland Basin. And it also is a result of our outstanding operational execution, which is ensuring that this cost advantage continues. Slide 11 shows how we continue to drive additional drilling and completion efficiencies in our program. Top-tier assets and premier operatorship is our mantra at SM, and it shows in our results. A third key advantage that we have is the emergence of sizable economic oily potential on our extensive South Texas acreage. As you can see on slide 12, actually, I'll show 13. Some of our new high-performing Austin Chalk wells there produce almost 60% oil. This higher percentage of oil from new production relative to our South Texas proven production will have a big impact on oil growth for us going forward. And oil growth will drive revenue growth, cash flow, and free cash flow. Our concept of premier operatorship, as you see on page 14, includes the idea that we must be a high-class ESG operator as well. As detailed here, we continue to make strides in our ESG performance and transparency, and we're committed to continued improvement in this area. In summary, We're well positioned to benefit disproportionately as oil prices stabilize and move up. We have significant liquidity and have been active in managing our downside risk. With that, I think we'll take questions. Thank you.
Thank you very much for that presentation. We really appreciate having you here as part of our conference. For those of you who don't know me, I'm Tyler Jones, an Associate Director here at Enercom. I'll be hosting the Q&A here for SM. First question that we have here is, in 2Q reporting, you all spoke to a 2021 plan that results in much better debt metrics than the street had baked in. However, I'm having a hard time getting my model to get the same result, specifically ending 2021 with debt to EBITDAX around 3 times versus street over 4 times. Can you give me a little more direction in how you got there?
Absolutely. Good morning. This is Wade Purcell. I'll take the first question here today. I guess the first thing I should say is, you know, during this time of year, it's still early days for formalizing our 21 plan. But what we did share, and what I'll share again today, is that we've ran various scenarios, and several of those scenarios enable us to achieve kind of the main objectives that we're looking for in 21 at the strip. And those are growing, generating free cash flow, either neutral or slight positive, and then maintaining leverage in the 3 times area. So that's, I would tell you that if you're struggling with those outputs, I would tell you to look at the production numbers first. And we said growth, and we mentioned pretty strong double-digit oil growth. And keep in mind that's coming off of a reduced 2020 number, first of all. And then on the cost side, $560 per lateral foot in the Permian is a pretty impressive number, clearly best in class. Make sure we're dialing that in. I think from a standpoint of DUCs, if you're thinking beginning of 21 to the end of 21, there's probably going to be a slight reduction there that could impact things. And then type curves. I suspect that a lot of folks aren't using the same type curves as us. They have been improving both in the Midland and Austin Chalk. So that, I think those are the key areas to look at. And of course, we can answer any questions. Feel free to call Jennifer anytime with specific questions. And we look forward to providing more details as we move through the second part of the year and formalize our 21 plan.
Fantastic. Thank you very much. Next question coming in here says, assume that you are increasing activity in South Texas next year if you plan to run 1 to 2 rigs. Can you talk about your strategy here?
And we're doing musical chairs here. This is for Bogle. So yeah, I'll get this one. And so first of all, just in South Texas, we're quite fired up about the results of our Austin Chalk effort. And that's really been the result of our geologic interpretations that have been extremely accurate and led to great opportunities for us. So, but fundamentally, we're not going to drill any wells that don't meet our investment hurdles. So what we really need is an Austin Chalk that is competitive with our Permian. And that's really what we've been proving up with our 9 delineation wells to date. We've got a lot of, from a big picture perspective, we've got a lot of opportunity to add a lot of inventory here in the Chalk. And it, of course, adds a lot of value to the company with that inventory. The Austin Chalk's definitely exceeded our initial expectations, and we reported in the deck, if you looked at it, and Jay just showed them, that the results are quite attractive. The key thing is they've produced, as Jay mentioned, almost 60% oil, and the total liquids as much as 80%, and that's really where the value accretion is compared to our former South Texas asset, which is Eagle Ford, where it was 6% oil and about 40% liquids. So that's the big uptick in value. Then we also pointed out the higher realizations we're going to be getting. So some of our contracts contractually drop our gas gathering rates by 25 cents in the middle of 21. And then long haul drops considerably by another 35 cents in the middle of 23. And then condensate realizations will increase near year end. And that's just one contract tapering off and potentially entering additional contracts there. So The whole strategy is really simply to generate returns and add value that way from the South Texas asset.
That's great. We really appreciate you giving us some color on the strategy there. Next question that came in, it would be helpful to have updated direction on your maintenance CapEx. I think you've provided that in the past based on the number of completions. Can we get something similar?
Yeah, I think traditionally, you know, we do this every year where we take a look at, okay, what would it take to maintain production flat from year end to year end? And because of our increased lateral lengths, and of course this varies with working interest and where we're drilling, we're at about 90 to 95 gross wells is what it would take to maintain flat production. And that on a net basis is about 80 to 85 wells. And, you know, you can translate that to CapEx. It depends a little bit on the lateral lengths and the assumptions, but it's in the 550-ish million range, you know, plus or minus some, just to maintain production flat. And that's a number we watch closely.
Okay. So the next question we have here, SM has a pretty robust oil growth outlook in 2021 with only 10% more capital year over year. Is SM going to be fracking a lot of DUCs in early 2021 to get a quick start?
So what we have is, as you know, we deferred activity, or we mentioned in the last call that we deferred activity as a result of pricing in the middle of the year. So that increases our DUC count by the year end 2020. And then during 2021, we do more of our CapEx towards completions. We're going to drain our DUC count somewhat. So you're going to see us go up above normal levels by the end of 20, and then drop below normal levels at the end of 21. So that's the intentional plan, and that obviously is very positive from a cash flow perspective.
Understood. And then on a hedging side of things, it seems SM is a bit more than 60% hedged in 2021 oil volumes. Does the company plan to hedge more volumes in the mid $40 in 2021, or is the company more willing to let it ride a bit and to hope for a lot more upside next year?
Good questions, Wade. We do, just to remind everyone and to remind you about our hedging philosophy and strategy, is it's very much linked to leverage. And the fact that we are in that 2.5 times area and 3 times area next year guides our hedging decisions. And that means that we hedge more to protect the cash flow, to protect the EBITDAX. So as we move through this year, I think you could anticipate, just to answer your question, a general increase in that hedge percentage as we approach the coming 2021. Something closer, we would target something closer to 75% as we move into that year. So.
Okay. On the oil field service cost side, single well pad contracts, or how are you guys managing the oil field service costs? Are you looking at single well pad contracts or longer term relationships that lock in service costs on a per well basis?
Okay, this is Herb again. We're actually quite a bit more, I'd say, holistic about that. So we are constantly rebidding services and grouping services, and tend to have longer term relationships on our rig contracts, and we have good relationships with our pumping service providers. So no, we're not doing it well by well. We are really lay out a program, and we really lock in that program around November to February in the budget cycle. Obviously this year we altered in response to circumstances March through May. But we are constantly rebidding services, and we're actively working with a number of different service providers constantly. Did that answer the question?
I believe so. I really appreciate you guys playing musical chairs with us too. Next question we had come in. Can you provide us with your investment hurdle numbers, minimums, base cases, et cetera, would be great between Midland Basin and Austin Chalk?
Well, we make our decisions based on DPI, so discounted profit to investment ratio, and we set a hurdle that achieves our objectives for the year. So when we're looking at investments right now, we use a more or less a modified strip pricing in our forward look, and we modify that each quarter and achieve the cash flow targets we want to achieve and the investment returns we want to achieve. And we rank our projects, obviously.
Thank you for that color. Next question we have here. Can you give us a little bit more information on your duct count and at what commodity price you might turn those in line?
I believe the duct count is in our deck in the appendix. So if you want to look in there, and I believe by the end of the year, we're probably going to be around 90 something ducts. I'll look at it right here for you. So yeah, our duct count gross as of June 30th is 95 and net is 91. And that's in the deck. And then it'll grow slightly by the end of the year, and then it'll be brought down lower by the end of 2021.
Excellent. Next question we had come in. How are you driving capital efficiency with your completions? How do you determine future performance from these improved completions, or are you relying on IP rates such as IP 30, 60, or 90?
Okay, it's a much more complex process than just looking at the IPs. So we are constantly testing different completion designs in a manner that allows for an apples and apples comparison. So that means you need to have like for like, meaning if you're in a co-developed area, that you're looking at the middle wells and you test on that scenario, and then we let it run for quite a few months to a year before we conclude that completion design is optimized. And we'll be now having a number of different tests underway at any given time. And what we're doing there is that the primary recipe that have changed over time is sand loading, obviously, fluid loading, stage length, cluster spacing, and then cluster design. And we move forward, and there were a number of things on mesh sizing also that allows to optimize. And there's a cost consideration, and then there's a production consideration, but it all leads to what are the optimal returns and value we get. And that's the focus, and meeting our hurdles.
Understood. And then to reach your 2x leverage position, will you achieve this through operations, through a monetization of an asset, or improved equity markets? What are you guys thinking there?
I'll pass that one to Wade.
That's Wade. I don't have a crystal ball for you there, but I can tell you, I think as we mentioned on the earnings call, that just looking at our plan that we're working with right now under several scenarios, it doesn't take a lot of price help to believe it or not to get below 2x. When we run 2022 in our plan, when we just run $50 through, which the strip is not far from now, and we do assume some cost increases in that scenario, we get to our 2x target before we get to the end of 22. So that's one way. There are other levers and that we'll look for as we move from here to there, but we definitely believe it's a very attainable target under different scenarios.
Okay. So moving now into a question that's a little more specific about the Austin Chalk. Excuse me. The Austin Chalk has had a varied history of hot and cold. What is different about the Chalk today? Are the drilling zones better? Completion technologies are better? Production infrastructure? What's different now?
Okay, that's an insightful question. So the Austin Chalk historically was a natural fracture play. If you look at wells that were drilled in the 80s and later, and what it's very specific geographically, what works in the Austin Chalk and where it works. And so if you look around and you do a lot of evaluation of horizontal wells that have been drilled in the horizontal and in the Austin Chalk, there's a lot of variability. So you really have to figure out, and this is the kind of the recipe you need to figure out on where does the Austin Chalk work and why. And what we found is that in our, fortunately, on our acreage, the permeability is higher in the matrix in the Austin Chalk. So we're not relying on natural fractures at all. It's really a matter of how we're able to steer into the best interval and then able to stimulate using pretty much standard completion designs, a little bit more sand loading than we have in Eagleford. Fluid loading similar, but it's really that the perm of the matrix where we are is stronger than it is to the north, and also stronger than it is to the south based on the data we see. And it's not at all like something in the Giddings field way over in East Texas.
Wonderful. That's all the questions we have right now. Let's give them one more minute to see if we can get one or two more. If not, we'll go ahead and wrap up. I'm not seeing any more come in, so we'll go ahead and end it there. SM, thank you very much for presenting at the Oil and Gas Conference. Always appreciate having you guys here. Thank you.
Okay, well, thanks for having us.